This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Hello, and welcome back to Fintech Recap. My name is Alex Johnson, and I am joined, as always, by our intrepid reporter, the publisher of Fintech Business Weekly. He's exhausted, but he's still somehow awake. He's up, he's jabbing, he's hooking, he's ducking. Jason Mikula. Jason, great to see you, as always.
It is great to be here. And I will say, the time zone arbitrage does help from time to time, as far as, getting a jump on the day on the news while everyone is maybe still asleep.
Well, I'm glad you mentioned that, actually, because a thing I often wonder about is, first of all, publishing the newsletter. Sometimes I feel like I'm in a bit of a race against other people or against people who said mean things on Twitter or whatever. And so, I actually could see the advantage of, I have a 4-hour head start before anyone is even going to see this, let's do this thing. And then also on Twitter, I have a really hard time, walking away from certain things or taking the time to craft an actually reasonable response to something. So I could see this arbitrage actually being an opportunity. I mean, I know you have to stay up at odd hours, particularly when you're on bankruptcy calls or whatever, but at least there's an upside to it.
Yeah, at one point I had deleted Twitter from my phone. That didn't last as long as it could have. But right. I am scheduled to take a vacation in 3 weeks.
Oh.
And I'm debating if I can leave at least my laptop behind. So we'll see how that goes.
Yeah, laptop behind, no Twitter, and just we'll survive without you. You've been very, very busy. In fact, I don't know how you've been getting any sleep because you've had a special project that you've been working on that I think you're going to take the opportunity to share publicly on the podcast. Could you tell us what you've been up to?
Yeah, absolutely. So I wrote a book, which as somebody who, is known to procrastinate was a challenge.
I have no idea how you did it because I'm right there with you on the procrastination. That's amazing.
But actually, literally, as of earlier today, the day that we're recording, my editor said, yes, okay, progressing to next steps. It is actually already listed as available for pre-order. The publication date, for some reason, is officially December 31st.
Wow.
So everyone has their New Year's Eve plan set. The name of the book, since I know you're dying to know,
I am,
is Banking as a Service, Opportunities, Challenges, and Risks of New Banking Business Models, which I actually came up with that title at this point, I don't even know, 10 months ago when I sent them the proposal, but it holds up well. And for our loyal listeners, you can get 20% off if you buy it directly from the publisher, which is Kogan Page, and use the promo code BaaS Island, all one word. I will drop the link and that promo code in the show notes or in the email that I send out.
I'll do the same.
If you want to support, Amazon or some independent online bookstore, you should be able to find it anywhere. I actually searched earlier on Target's website because that is probably where my mom will buy it. And it is on there. So yeah, that is the big news. And I'm relieved to be mostly done and be able to talk about it now.
Wow. Well, first of all, congratulations. This is quite an accomplishment. I'm amazed, honestly, given all the other work that you do, that you somehow carved out time to write a book as well. There's literally no chance in hell I would ever be able to do that. I'm so impressed. And, seriously, congratulations. This is awesome.
Thank you.
This is so exciting. And a special promo code, BaaS Island, for listeners to go out and order your own copy. I will include the link to the publisher's page on the book. I looked this morning. The cover looks cool. I love the title. I am amused to think about, as we were going through the depths of all this drama over the last 10 months, what other alternative titles you were considering maybe at various times. But kudos for sticking with the original title. I think that still is a fair representation of BaaS. And again, this is so cool. Everyone who's listening should go out and buy a book immediately. I will be doing that myself. And, who knows, if you try to ambush Mikula on the conference circuit this fall with your book, maybe he'll be good enough to sign it for you as well.
I'll carry around my Sharpie so I'm ready. I'll practice my signature. It's not good.
That's a big thing. As a published author, you have to have a cool signature. So I can't wait to get my book signed by Jason this fall. I'm sure everyone listening feels the same. Such a cool note to start off our podcast. And because of that promo code, Mr. Mikula, I hate to make you do it, but maybe we should make at least one more return trip to BaaS Island. So, Jason, our intrepid embedded reporter, why don't you tell us what the hell is going on? Because there's been a little news since the last time we recorded.
There has been I think a couple pieces of news, actually, but we'll start with a big one, and then we'll see what else we can fit in. Because we are committed to beating this into the ground, I have to say that pirates have invaded BaaS Island. And what I mean when I say pirates is a Russian cyber gang called Lockbit, which has leaked a massive amount of data from Evolve Bank and Trust. I will give sort of like the quick backstory, and then we can sort of discuss what the implications may be. So this organization, Lockbit, known Russian cyber ransom group, had posted that it had a cache of data allegedly from the Federal Reserve that it was going to release if this ransom was not paid. The files were published or became available the last week in June. And it became clear pretty quickly that it was not the Federal Reserve, but it was actually Evolve. The size of the files is allegedly around 30 terabytes, although in speaking with various information security researchers who have accessed the files for purposes of risk mitigation, they've said that there are a lot of duplicate files within that, but there are also compressed files within that. So it becomes very, very difficult to, just from a number perspective, understand the size, apart from it being truly, truly massive. One source with whom I spoke said that it appeared that Lockbit had compromised Evolve's Azure instance.
Oh, sure.
Which is Microsoft's cloud server, and had been able to make copies or images of most or all of Evolve's virtual machines. So these are essentially servers that are running in the cloud to power different services like the website, FTP, SQL, which is a database, and just massive, massive amounts of data. I've been able to review a very small subset, literally like a couple of files, with the assistance of trained researchers who know how to do this in a safe way. And, they do contain everything that you would not want to be unencrypted and publicly available: names, addresses, SSN or TINs for businesses, account balances, account numbers. I've been told that card PANs or primary account numbers are in there. I mean, literally basically everything. Also appears to include Evolve's internal emails. And it's also worth pointing out, the scope of this, even on the first order of magnitude, right? So Evolve and fintech programs on Evolve, which include names like Affirm, Dave, Mercury, Wise until late last year, built back in, I think, like 2022. The scope is already gigantic, but it's been pointed out to me that Evolve is likely one of the largest ACH originators in the country, meaning potentially anyone who's sent a payment to or received a payment from one of these firms could also have some amount of data in this breach. So, I mean, truly unprecedented in scale. It comes, I think, just a couple of weeks after Evolve received a consent order from its primary federal regulator, the Federal Reserve Bank, which, among many other things, included a requirement around remediating info security weaknesses, deficiencies. So the scope and severity of it is a surprise, but I don't necessarily think it's a surprise that Evolve's information security practices were not up to snuff. I will pause my monologue for you to react.
Well, I mean, this is incredible, not in a good way, obviously. But, it is shocking, honestly, because we just are kind of a slightly quieter period, although still obviously ongoing after the Synapse meltdown and mess, which Evolve was like intimately involved in and was like a major party too. And now we have this that happens. Obviously, it happened back in May. this is part of a ransomware attack. So you sort of are waiting for the countdown to get to zero before the data is released, which it was. But a side note, I find ransomware as a business to be really weird, where they're like, pay us or we'll give all this stuff away for free. And you're like, well, I don't want to pay you because if we pay, then that'll just incentivize future people to do it. Like the dynamics of it are very, very strange. And I'm sure law enforcement was involved in advance of the actual deadline coming. It was also very strange, by the way, that they said they hacked the Federal Reserve. I don't even know what that means, honestly. And so that was like a weird bluff. There's lots of things with the ransomware that I don't understand, but we'll set all that aside for the moment. I mean, I think my initial reaction, just generally, building off of that point you just made, is this isn't that surprising. I mean, obviously, anyone can get hacked. And there's sort of, I think, a practice generally in the space of like, don't ever celebrate when one of your competitors gets hacked because everyone is kind of living on borrowed time and it could happen to anyone. But if it was going to happen to someone, it doesn't terribly surprise me that it was a bank that has a really, truly breathtakingly comprehensive enforcement action against it from its primary regulator that specifically called out its information security practices and that has just seemingly been kind of behind the eight ball on a huge number of different things in the banking as a service space. And I guess, Jason, the thing I would turn back to you, and it's something I wrote in my newsletter today, is I don't think you can really extricate whatever sort of information security weaknesses existed at Evolve from the rest of the characteristics of Evolve, some of which made it very attractive as a partner in the fintech space. And you touched on in the newsletter that you wrote immediately after this happened that while reviewing some of the data in the files that were released, it appears that there were some pretty significant lapses at Evolve as it relates to some of their programs for AML, for KYC, for KYB. And I mean, truly like very basic stuff like, hey, this business that just applied to get a business bank account, they say that they're based in the US, but all of the easily accessible data about them suggests they're actually based in Pakistan. Like, that's a pretty easy thing to flag and to reject. And they just seem to kind of sail through at Evolve when working with some of their fintech partners. And I don't think their sort of lax attitude about AML, KYC, and just sort of the programs that they enabled for their fintech partners, it's not surprising that that same bank that allowed that stuff to happen also maybe wasn't totally on top of everything from an information security standpoint. So I think that all of these things kind of get bundled together into this question, which is, if you're a fintech company, what partner bank should you pick? And what are the characteristics that you should care about as it relates to that partner bank? And I think what we've learned, both through the Synapse mess and now with this Evolve data breach, is some of the characteristics that you think you might want might not actually be the things that long-term are good for you or good for the ecosystem. What are your thoughts on that?
I think that framing is exactly right? The short-term benefit or what's attractive versus the long-term, right? And I mean, this talking point has been beaten into the ground at this point, but like the appeal of some of the BaaS players and, middleware players was speed to market, cost to market, right? So if you're a venture-backed startup, or even before venture, if you're, a friends and family round or a pre-seed, seed round startup, you want to be able to get your product live so you can start demonstrating product market fit, start demonstrating growth, so you can go raise more money. And so at those earliest stages, the imperative is, how fast can I do this? What is the path of least resistance? And you can imagine, if you call up Bank Corp and you can even get them to call you back, and you get an answer that's, we have a backlog of all these programs. You have to fill out all this due diligence stuff. We want to see that you have a minimum of, X, whatever, hundreds of thousands, millions of dollars of capital.
We're going to throttle your onboarding when you start so that like you're not going to be able to onboard as fast as you want. We're going to send X amount through manual review, even if we don't have any concerns, blah, blah, blah.
And then, you're like, ooh, that sounds hard and slow. And, you call some other players and you get an answer that sounds more appealing. It's, at least in that short-term perspective, not surprising that people would sort of make a decision of what is the easiest, fastest path to get this done, because, if I don't get live in market, it's not going to matter one way or the other. And I mean, this isn't something that's uniquely true to the sort of BaaS or middleware stuff. I mean, I had some of these experiences myself earlier in my career where, hey, if we don't grow quickly enough, in that case, it was more around some credit policy stuff and some, marketing practices. But if we don't grow quickly enough, we're not going to be able to go raise more money. And so you do have these mismatched incentives where we've seen in these consent orders and the banks that have been hit with them, growing quickly in banking is pretty much always
Yeah.
a red flag, at least worthy of further examination of, hey, you added all these accounts and all these deposits and all these loans. If you're doing that very, very quickly, it's worth pausing to ask, do you have the right controls in place? And unfortunately, we've seen time and time again, at least, with the consent orders, I'd say in the past 2 years, that all too often the
Yep.
answer is no. I think, Evolve seems to be sort of taking that to the extreme degree.
Yeah, it's like they're trying to win an award for worst BaaS bank. I mean, honestly, it's almost as if they're trying to do it intentionally, as how many bad things have happened over such a short period of time. It's like middleware platform that's going to melt down, check. Consent order that's going to sort of set the standard for the worst one anyone's ever seen, check. Obviously, massive cybersecurity problem, check. Like, they are literally hitting every note of what could go wrong in this particular environment.
It is interesting that it's not like it's only sort of like weird, sketchy crypto Web3 kind of programs. I mean, it is some of the biggest names in fintech
Yeah.
that were built on Evolve. I mean, Affirm's debit card program, not their loan stuff. Mercury, which is a hugely popular business bank account that really grew extremely quickly in the wake of the collapse of SVB, Wise. Like, these are not small
No.
rinky-dink programs. And so it is interesting. And I don't have an answer to this question, but it's worth asking, why was there such a concentration of these programs at one single bank when there are, sort of depending on who you ask or how you count, 100, 130 banks that play in this
Well,
partner
that's a great
space?
question. And it's actually something I've been thinking a lot about as well, right? Because there's a lot of factors that would suggest that the future of banking as a service is a winner take most kind of market, right? Where it's like a small number of banks that make it through this regulatory gauntlet, get to the other side, have sort of regulator approved controls and processes in place to do banking as a service safely, that have the technology to be able to interact with fintech programs and allow them to get started relatively quickly. I mean, I think to answer your question about why people picked Evolve, I think part of it was their sort of really loose attitude around compliance and onboarding and that kind of stuff. But probably part of it was also technological, and they were a little easier to work with. Maybe they had APIs that you could interact with. So I think, technology is definitely a part of it. But you could see a world in which we fast forward through all of this stuff we're going through, and we end up with a market where there's, I don't know, half a dozen, maybe a little bit more, like really tried and tested partner banks that are sort of seen as like good choices for fintech programs to work with. But that then suggests another problem to me, Jason, which is we just demonstrated the concentration risk that goes along with banking as a service, right? All of these programs were built on Evolve. Seemingly they were like, I don't know, half the like major programs in the US. I mean, it's like a lot of partner banks or a lot of fintech programs that were built on one partner bank. And just from like a cybersecurity, data security standpoint, the concentration is bad, right? Like giving hackers a small number of targets to go after, even if they're very hard targets, is generally not what you want. And so I sort of struggle with this. This is a longer term question I was kind of contemplating in my newsletter that I wrote about this. There are certain parts about banking as a service that would suggest it's better to have a more concentrated market with tried and tested players. But then there are other things like what just happened with Evolve that would suggest maybe we want a more decentralized one where there's not one big target to hit. Like this was the worst possible bank to get hacked in terms of the impact that it would have on the fintech ecosystem. And so I don't know. I really struggle between those two different dynamics. And I think an obvious solution might be, hey, let's just, have the market shift more to bigger banks that are even better at, data security and are even better at compliance and like have just like that hardened infrastructure that's like more difficult to break into. But, and you would know this better than I would, there's a lot of reasons why fintech programs prefer to work with smaller banks. And it's not just Durbin exempt interchange. It's not just finding banks that have literally no idea what they're doing and will say yes to anything. Like, smaller banks are easier to partner with. They're more flexible. They're willing to be a little bit more friendly in negotiations on revenue splits. And so, like, there are legitimate business reasons why you would prefer to work with a smaller bank than like a JP Morgan Chase. And so, I don't know, like, in terms of how BaaS evolves, I don't really see a clear answer where, oh, we're all going to go towards X, because there are all these kind of competing dynamics that don't point to an obvious answer.
Yeah, well, and I think in some ways that mirrors the banking market
Yeah,
as a whole, right? I mean, if you think of like setting aside like the fintech stuff, it's like, well, look at really literally any other country. You usually have 4 or 5 banks that hold, 50, 60,
that's right.
80% market share, and then, maybe, a handful more. The US, for a whole bunch of reasons, is really unique in this regard. And, could you make an argument on the one hand that, hey, like if you just had JP Morgan Chase, Bank of America, Wells Fargo, Citi, and just let them gobble more banks up and get bigger and bigger and bigger, in some sense, would that make it easier to monitor and regulate them? Maybe. But then on the flip side, you get the too big to fail concentration risk becomes even worse as a
Not as much
result of that.
competition. Like you look at like, well, no, I mean, it's a good point, right? Because then like the reason that banking regulators and folks who work on policy and financial services don't want that to happen, because obviously all the big banks would like that to happen, but the reason we don't want that to happen just generally as a society is then, you don't get that same level of competition. There is more of that sort of too big to fail risk. I always joke that like fintech in Canada is sort of a vision of what fintech in the US would look like if we only had, 4 big banks or 5 big banks. Like, it's not great, right? Like, you don't get that same level of competition. So it is tough, but I wanted to flip it back around real quick to the consumer side of this, right? Because we just went through the Synapse mess, which I think was a really painful lesson. I mean, you have these folks in your DMs on Twitter, right? Like, people who thought their money was safe, people who saw FDIC insured on the website and just sort of assumed they knew what that meant, which again is not a bad assumption, but are now learning that the FDIC insurance doesn't quite do what they thought it did and have not had access to their money. We just went through that with Synapse, which again, Evolve was tied to and was very much a part of. Now we have this Evolve mess, and you've been doing some reporting on this as well, and I've seen it come out too. People are getting notifications from major fintech companies or brands like Shopify, perhaps, that were powered by Stripe Treasury for the business bank account that they offered. And those notifications are saying, hey, so your data was breached. We don't exactly know what the data was that was breached. Here are some things you might want to think about doing in the interim while we try to find out more about what might have happened. But just so you know, there is maybe a chance, or you might hear this reported elsewhere, that a lot of your data was in there. And this was really just on its face a massive, massive data breach that, and this is the part that's hard to explain, had nothing to do with our systems technically, but it was with this bank that we worked with. It was listed in our terms and conditions, but you probably never looked at. Like, this is another huge body blow to trust in fintech beyond what we just saw with Synapse, right?
No, absolutely. I mean, I can only imagine. And actually, I got
I did too.
already one of these
Yeah.
emails over the weekend, and I was like, I mean, I knew it was going to come, but it was still, I don't know if amusing is the right word, but to see it show up in my email box on like a Saturday or a Sunday night, be like,
Yeah.
oh, yep, there you go. And yeah, I mean, you're exactly right. It's a bit different, but I think for your average consumer who's sending money to a relative through Wise, or who uses Dave as their bank account, and probably has never heard or thought about Evolve Bank and Trust, to be like, what's this random tiny bank in Arkansas, and like, what does it have anything to do with me and my information? So, I mean, I think there's a couple of different angles. I mean, one, the one you raise, which is, consumers trust in these kinds of services, even though, I don't think anyone at this point is saying that Dave or Affirm or Wise or whoever did anything wrong from an InfoSec perspective. However, like, whether you want to call it supplier risk or third-party risk or reputational risk,
Yep.
or what have you, it's like that is sort of baked into it when you have this disaggregated model of, as a consumer, I open up my phone and I see Dave. I don't really know that, oh, well, there's APIs that are connecting to this bank, and maybe there's a whole slew of other
Yeah,
service providers that are doing things like identity verification, payment processing, and what have you. So for a consumer, I would imagine they're mad at the company that's sending them this notification being like,
of course.
what the heck? Like, why
Yeah.
weren't you doing your job when, let's say they're not the proximate cause of what's happened here. I think a secondary audience, and it's going to be interesting to see how they react, is the regulators. I mean, after the Synapse meltdown, there's sort of ample ammunition to be like, see, this model doesn't work. It causes all these problems. It's not being operated responsibly. And this really takes it to the next level.
No, I mean, I was thinking that same thing. I mean, first of all, again, I would just like to register my shock that it took this long for Evolve to get public facing enforcement action. Like, what do they have to do? How many more emails from Mr. Mikula do they need to be like the main character of before this happens? But I think it does raise those exact questions. And we're not, we don't know what the end state looks like, right? We know that regulators are aware, obviously, of everything that's been happening. There's a limit to what they can do to fix any of these things, right? Despite the pleas of, McWilliams or, any of the other folks that are involved in trying to unwind some of these messes, there's a limit to what they can do to fix what's happening now. But I can tell you for a fact, they are thinking about how to stop these things from happening in the future. And yeah, I mean, I think it's going to have a huge impact on this because this is, as you said, a great indication of supplier risk. Like, this is what supply chain risk or sort of counting on third parties looks like. And what's funny about it is prudential regulators always talk about supply chain risk or third party risk or fourth party risk or fifth party risk in terms of the bank and working backwards from the bank to their third parties. But what this, I think, illustrates is, from the consumer's perspective, the first party in the chain is Affirm or Dave or Built or, whomever. That's who I, as the consumer, am working with. And it turns out that the supply chain risk goes the other way too, because, and I think you put your finger right on it, I'm sure Affirm and Dave and Ernan and all of these companies, I'm sure they felt really good about their cybersecurity and information security practices. I'm sure that, they were feeling relatively confident. Now, again, breaches can happen to anyone. You never feel 100% confident, but I'm sure they felt like we're doing the things we're supposed to be doing. And, oh, yeah, we trusted this one little bank that we're doing some of these things with, but like, I'm sure that'll be fine. It was not fine, right? And I mean, people have been asking very reasonable questions about things like, well, how is it that you can have obviously an instance with Microsoft Azure where all of this data is going back and forth, and for the data to not be encrypted at flight and at rest, right? Like, there's some like very basic things seemingly that Evolve wasn't doing, and we're still waiting to find out the exact causes and what could have been done to prevent this. But it's not hard to think, wow, they were doing things that none of their partners would have done if it was themselves, that none of their partners were probably doing, but they trusted a company that was getting all of their information, all of their customers' information, and this is what happens. So from a regulatory perspective, I don't know what it's going to look like when we sort of see how all of this finally gets unwound, but you can be damn sure that regulators are looking at this and going, okay, now we have to open up this whole other area that probably we weren't even thinking that much about or that deeply about. And this is a whole other, can of worms that we need to dig into.
Yeah, I mean, and now I feel compelled to bring in the Kia Haslett point of like, who is the service provider
Yes.
to whom? I mean, my mental model historically has, at least like the legal construct has been that these customer facing fintechs are third party service providers to the bank. But I mean, your point that particularly from like a end consumer perspective, it's the inverse of, well, the bank is a service provider to Dave or Affirm or Built or whomever. The problem with that is that depending on exactly what they do, most of those firms have no licensing or regulatory oversight, right?
Right.
So, if we're saying this runs the opposite direction and a bank is a service provider to a customer-facing fintech, there is no clear paradigm for who should be overseeing those customer-facing fintechs to make sure they're picking a bank that is
Well, I mean,
competent.
that's exactly right. And I think it is really hard, right? Because I think in a lot of ways, not just from the consumer's perspective, the bank is the service provider, right? We saw this in BaaS over the last 5 years. Who had the power in that relationship? Who had the negotiating leverage in that relationship? It wasn't the bank in most cases. I mean, it is now a little bit more because, supply has dwindled to almost nothing and it's hard to get a partner bank. But for years, banks were fighting tooth and nail to get fintech partners, and the fintech partners had all the leverage in that relationship. And if you are doing that job and picking your suppliers with care and you have the leverage, one of the things you should be asking for is, okay, show me what you're doing from a data privacy perspective. Show me what you're doing from an information security perspective. Like, this is a sort of a funny thing to say, but what was the RFP that fintech companies were sending to their potential bank partners to fill out and give them information back on how their operations worked? I say that as a joke because there was no RFP. There was no process that fintech companies were putting their banks through, but that's the supply chain risk they were taking and not thinking about. And now we're seeing the outcome of that. So I think you're right. I think we're going to have to rethink the sort of bi-directional nature of that supplier relationship and come up with a better framework for how to manage that, because there's lots of risks that no one was paying attention to. Mikula, before I let you off of BaaS Island, before I airlift you off for a little break, can you just run through real quickly for anyone who's listening who's concerned about their own data, which you and I, unfortunately, are both concerned about personally, what could people be doing to at least take steps to mitigate some of the risk here?
Yeah, this is the FinTech Recap PSA.
Yeah. We don't do a lot of these. But go ahead.
Which was an email I sent out to my family and friends and phone calls I made over the weekend. I mean, common sense things that everybody can do or should do: not reusing passwords across multiple sites, enabling multi-factor authentication, preferably with an authenticator app if possible, although most US banks don't do that. So be SMS or email. Using passkey login where available, freezing your credit file at the major bureaus unless you're planning on applying for a new credit line. Even consider freezing your files at specialty bureaus. People forget about these. There's like dozens and dozens of specialty bureaus like Check Systems and LexisNexis. If you have reason to believe your data is compromised, adding a fraud alert to your file, using a service like Credit Karma. A lot of banks and credit cards also offer this, to look for unexpected activity. So like a new trade line that's been opened that you didn't apply for, a new hard inquiry. This actually happened to me like 2 months ago. I saw a hard inquiry on JP Morgan Chase and I'm like, I didn't apply for anything. That's very weird. So it's helpful to be able to get that information in real time. And then if you have been a victim of identity theft, filing a police report, because you may need that in order to help you remediate the problem.
Thank you for running through all of those. Good practices just generally, and unfortunately, very, very relevant ones at the moment. Jason, I lied. Before I let you off BaaS Island, give me like 30 seconds on Thread Bank, because they had a little fun happen as well.
Yeah, so Thread Bank is the latest BaaS bank to get a consent order. It's kind of an interesting history. So, I mean, the bank prior to becoming Thread, had some issues in that it wasn't making money. And when you're a bank, that's a problem. Well, when you're any business, that's a problem. So, I mean, it had a consent order and then a couple prompt corrective actions, which is basically the FDIC saying like, hey, like you need to figure out your capital. Otherwise, like you need to get acquired or merge. So a new management team came in, recapitalized the bank. Previously, it was known as Civis. It became Thread. New equity, new management team, new business model. And a core component of that new business model was banking as a service, ramped up pretty aggressively as far as onboarding new programs, particularly because in addition to doing direct programs, it's partnered with Unit. Unit had programs on Blue Ridge that then moved over to Thread. So there's kind of like a big influx there. Compared to some of the other consent orders, relatively narrow, not as far-reaching as some of the ones we've seen with other banks in the space. And from talking to people in the ecosystem, everyone seems to have a fairly high opinion of the management team. And so, I mean, this seems like a situation of clean up the problems, improve your controls, do what the order requires, and live to fight another day.
Well, I don't really have much to add to that. I read the consent order as well, and that was my takeaway from it too. Relatively narrow, not overly restrictive in terms of, you can still bring on new programs. You don't have to necessarily exit programs. So it didn't seem quite as constricting the way that others are. But, at the same time, you prefer not to have public enforcement actions if you can avoid it. And, as you mentioned, Unit is a big partner of theirs. In fact, I think Threadbank is, just by number of programs, the sort of biggest partner bank that works with Unit. So definitely not good, but also not something that can't be remediated and fixed. So we'll leave that there. Jason, we'll get you off of BaaS Island. Can I give you a non-BaaS story that we can spend a few minutes on?
Please, please. I haven't heard any news except for this stuff. So
Okay,
tell me
well,
what else
I
is
mean, I know
happening.
you saw this. Probably didn't get a chance to write about it, though, because your newsletter's been completely co-opted only by banking as a service, but it's one of your favorite topics. Buy now, pay later. So you probably saw that it's kind of an interesting way that the news broke, but it was first announced that Affirm was going to be adding their products into Apple Pay. So you'd be able to get Affirm loans presented at the point of sale when you were checking out using Apple Pay. At that same time, and Affirm, of course, is what got all the news and everyone got really excited. It was also announced in that same news dump that in addition to Affirm, Apple was working with specific credit card issuers, Citibank, Synchrony, other banks in other countries as well, along with card issuing providers like Fiserv to enable specific card issuers, debit and credit card issuers in Apple Pay, who are already integrated to Apple Pay, to be able to add their own installment lending options to be presented to customers at the point of sale through Apple Pay. So both individual issuers and Affirm were suddenly able to compete for buy now, pay later in Apple Pay. Now, shortly after that, it was also announced that Apple was going to be killing its own pay in for buy now, pay later product called Apple Pay Later, which ironically had just started to roll out and be publicly available. I don't even think it had been a year of full availability of Apple Pay Later in market in the US before Apple decided to kill it. And what's notable about Apple Pay Later was this was the first product that was really launched as part of Apple's Breakout initiative, which was reported in Bloomberg. And the idea behind that was that Apple was going to be taking a more active role in building out their own financial products and relying less on partners. So instead of doing buy now, pay later through an Affirm or through a Klarna or through a bank partner, they were going to be doing a lot of it themselves, which they did. They were the balance sheet behind it. So they were doing all of the funding for the loans. They were underwriting the loans. They had gotten their own state level lending licenses to be able to originate the loans on their behalf. And so apart from a small role that Goldman Sachs played in actually issuing a card to facilitate the transaction in real time, everything else, for the most part, was being done directly by Apple. They're not doing that anymore. And Mr. Mikula, I'm curious to get your thoughts on this. It's kind of a weird move. And I've written about it in my newsletter. I've speculated a little bit as to why they might be doing it, but it's a pretty abrupt change. It's a pretty significant change in their strategy. And I don't know, it might hearken to other changes that they're making to their approach when it comes to financial services. What was your read on the situation?
It felt weird. I mean, particularly given how brief the time period has been that it's been live in market, right? I mean, you look at something like Apple Pay, and at least in the United States, the adoption curve on that was like very slow. I mean, I feel like it wasn't really, between point of sale acceptance, which just given, the size of the United States takes a while to have everyone have NFC capabilities, and consumer habit, consumer behavior. I feel like it wasn't until like the pandemic that Apple Pay sort of like really became like a thing in the US that was used broadly. I guess I don't actually live there, so it's harder for me to say.
No, it's true. It's true. Especially if you live like in Montana, where we don't exactly embrace contactless quite the same way everyone else does. It was a slow burn.
Yeah. And, they showed a remarkable amount of patience at building out that capability and encouraging adoption. So the about face on Apple Pay Later, use the word abrupt. I think that's exactly right. I think for sort of full general availability, I think it was like less than a year. I actually signed up for it and never had a chance to use it. So I guess I'll never know. I guess I'll never know how it works. I mean, I'm curious to hear your opinion on why you think, they made this shift. And my head went to okay, do they not want to take the regulatory risk? I mean, the CFPB is going to be up in their business anyway, presumably because of, Apple Wallet and Apple Pay. But did they not want sort of the heightened scrutiny of actually having a lending product in there? Certainly in the EU, there's stronger lens on antitrust risk as far as how Apple sort of steers or bundles things. And I mean, the product wasn't live in the EU, but by shifting from sort of a vertically integrated strategy to a platform strategy, they're actually going to be able to go global with it much more quickly than if they tried to do that by themselves in every jurisdiction. It does make me wonder about the future of Apple Card and whether or not that may get killed off as well. I assume, I mean, that has to be more complicated given that, there's a contract and an agreement with Goldman. Goldman wants out. They seem to be having a problem finding another bank partner to
Shocking.
get over. So substantially more complicated than, as you pointed out with Apple Pay Later and it being almost entirely on Apple minus some supporting pieces. The ability to pull the plug on that quickly, was there. Whereas with Apple Card, the off ramp to that might take a little longer to find. And honestly, to me, if they truly are shifting to more of a platform strategy, that makes sense. Being a platform business and putting up toll booths on your distribution is a great business to be in. I mean, I forget. I think it was maybe with the 11FS podcast. I was talking about if I were in charge at Apple, why not build essentially the Credit Karma, but inside Apple Wallet? So instead of issuing the card yourself, holding the credit risk and all this other stuff, build a platform, vacuum up a ton of data, sell it in a consumer permission, transparent way, particularly with things like mobile driver's license slowly rolling out. You can imagine, Apple having some sort of deal with various issuers where, they can pre-qualify within Apple Wallet. Apple knows your Apple ID, knows how long that's existed, knows what payment cards you have linked to your Apple account. You have a mobile driver's license, maybe one day. You start to see a picture of Apple as gatekeeper and charging a toll, as opposed to Apple taking all this regulatory and antitrust risk, as well as credit risk for actually offering lending products on its own. So we'll see if that's where it's really going, but I'm curious to hear your point of view.
Yeah, I think you hit on all the major points I was thinking about as well. I mean, just to recap on how the Pay Later product actually worked, it was kind of weird because it was, and this speaks to your broader point about are we a platform or are we a financial services provider? It was very strange because to get access to Apple Pay Later, you had to be, at least initially, an Apple Card customer. And you had to go in through the Apple Card in the Apple Wallet and kind of dig through the multiple layers of menus. And then you had to apply proactively to be approved for Apple Pay Later. And then they would underwrite you and say, okay, now you're approved. And now then when you go back and you try to do a transaction through Apple Pay Later will show up as an option. So it was a very weird, convoluted user experience that I think speaks to the challenge Apple had in sort of putting a wallet with their own products, but also other people's products next to each other from a user interface perspective. I've written before about Apple Wallet just from a user interface and kind of UX design perspective is kind of a mess and very un-Apple-y in a lot of ways. And I think that, Buy Now, Pay Later was a really good example of where that mess was really starting to become visible and become painful for users. Another thing that's worth probably noting is that, as I understand it, Apple Pay Later was reliant on MasterCard's Buy Now, Pay Later scheme for actually processing the transaction. And one of the things that was interesting there is that MasterCard's Pay Later installment sort of scheme that they built on top of their rails was really unpopular with merchants because it was very expensive. It was much, much more expensive than typical interchange transactions. And they provided an opt-out to merchants, and pretty much all the merchants opted out. And so I also wonder if that sort of opt-out and sort of infrastructure problem on the back end contributed to Apple Pay Later not getting as much adoption maybe as they thought. So I do think that was a part of it. I do think the regulatory risk can't be understated at all, right? if you know anything about Rohit Chopra at the CFPB, you know he's just licking his chops, waiting for opportunities to go after Apple because he's really a sort of antitrust guy in his heart of hearts. And so Apple is like his white whale. He just really wants to like get inside Apple and find bad things that they're doing that are bad for consumers. And, obviously he's going to find opportunities to do that anyway. Those opportunities are going to come up through open banking. Those opportunities are going to come up through sort of their supervision of large non-bank entities, which they've sort of revved up in recent years. But operating your own lending business and having your own state level lending charters, that's like a very obvious way to just invite the CFPB and other regulators inside your walls. And, to your point, Jason, how much margin are you really picking up by doing that? And that was always the thing that was strange to me about Project Breakout is really like you're doing all of this and taking all of this risk to pick up, I don't know how many basis points of additional margin on every one of these transactions. Like, you're Apple, you make trillions of dollars. Like, what are you doing? So that always seemed a little strange as a calculation to me. But then I think the other point that's worth emphasizing is, and this is the thing I'm kind of pushing back on with people who are commenting about Apple, like getting out of the buy now, pay later space. An easy way for Apple to get out of this would have been to just say, okay, Affirm is now our exclusive buy now, pay later provider. That's what we're going to do. Like, we're getting out of this game. We're going to pick one partner, maybe a couple, and we're just going to say, these are now buy now, pay later within Apple Pay. We're going to wash our hands of it. We're going to negotiate a nice deal with those providers, and it's done. Or alternatively, they could have done that at a network level. So they could have gone to Visa or MasterCard, probably not MasterCard because they maybe didn't have a great experience there, but they could have gone to Visa. They could have said, okay, we're going to enable this scheme at a network level and let anyone participate in who wants to be it. Kind of how they enabled Apple Pay originally. That's not what they did. What they did was, and this is according to Tom Noyes, who covers the payment space about as well as anybody, they built their own scheme to enable pay later functionality within Apple Pay, which means they have to work on an issuer by issuer basis or with processors like a Fiserv to enable this one partner at a time. That's a lot of work to do that. And what that tells me is they are actually very intentionally trying to pivot to more of that platform strategy that you're describing. And I think there's a lot of reasons for that. I think it's a generally better business model, as you described. I also think they're probably feeling more pressure on the wallet level than they were before, because in the EU, you are seeing regulators trying to force Apple to open up some of its capabilities to enable other providers to build wallet or payment type experiences and take advantage of Apple's operating system and hardware. And then even in the US, you're seeing competition from other wallet providers, right? Pays is coming, which is the EWS wallet product that I don't think any of us really fully understand. But one of the things I saw from Pays was they are, without user consent, opting you in automatically to have all of your cards added into Pays. So they are very aggressively trying to like pre-onboard users to compete with Apple and PayPal and others at a wallet level at the point of sale, particularly for e-commerce. So I do think Apple probably looked at all of this and said, on the one hand, what are we doing taking all this risk for not that much additional margin? And on the other hand, we're kind of letting this wallet opportunity that we have slip away from us. And so I think all of that is probably true. To your point about Apple Card, I would guess that if they're backing away from Project Breakout, they're probably also gently backing away from the just like Apple Card. We have to own it. We have to exercise a lot of control over it. Obviously, Goldman Sachs said, hell no, we don't want anything to do with this. All the other big issuers have basically looked at it and said, you're not getting in a deal anywhere close to what you got with Goldman Sachs if you want to move that over to us. And my educated guess, and again, this is just a guess, would be that eventually the Apple Card ends up with an issuer that gets a better arrangement with Apple that's more sort of even, and that Apple probably doesn't kill it right away because there's no benefit to killing it necessarily, because there are some Apple Card users and they seem relatively happy. But I would guess it kind of goes more into maintenance mode and they just sort of like let it sit there. They don't really aggressively market it. I mean, they're putting a lot of money in to marketing it and growing it. Like when I listen to non-fintech podcasts, I get a lot of Apple Card ads that, come to my ears. And so I think they might just kind of back off of that and slowly pivot into more of a platform, good partner model, as opposed to this kind of dual model that they've been pursuing. Jason, do we have time for just a couple quick topics that we can run through before we get to Can't Let It Go?
You're going to have to carry the weight, but yes.
All right.
So I know what
Well,
Chevron is.
let's
I
talk
don't
about
have a
Chevron.
good.
So, because neither one of us are lawyers, nor are we in any way qualified to talk about it, so let's talk about it. My understanding
Yes.
is the news that came from the Supreme Court is that the Chevron Doctrine has been overturned. And for all of the non-lawyers who are listening, we'll try to explain what that means. For any lawyers who are listening, just cover your ears and go la 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 for the next couple minutes. What we know is that the Chevron Doctrine essentially allows for regulators, federal regulators in the US, to get the benefit of the doubt from courts when they are applying existing statutes or laws to new or novel situations. And so the basic idea is that a lot of these laws that govern, let's just pick on financial services, things in financial services that weren't necessarily originally foreseen when the laws were written, because a lot of these laws are very old, the choice that regulators have when they're doing rulemaking around those statutes is to say, hey, we think that the intent of the law is this. And so even though the letter of the law didn't necessarily anticipate cryptocurrency or didn't necessarily anticipate banking as a service, we think that we can apply the law in this way, and our rulemaking and our enforcement is going to take this view of how this law applies to this new novel situation. And that absent any clear and compelling evidence that they were really overstepping their bounds, this doctrine, the Chevron Doctrine, essentially instructed courts to say, okay, we're going to give you the benefit of the doubt. Yeah, because regulators know better, essentially was the idea. By overturning that doctrine, the Supreme Court is essentially saying, and Jason, correct me in your, I feel like you're more of a non-lawyer than I'm a non-lawyer, so I feel like you're better like suited to correct me if I'm getting anything wrong here. But essentially, the Supreme Court is saying either Congress needs to update the laws that they pass to compensate for some of these lack of being able to foresee the development of new technologies or new use cases. Or if Congress doesn't do that, then this deference that we were paying to regulators, that goes away. And it opens up regulators to a lot more judicial challenges where we want the courts on a case-by-case basis to be deciding, oh, in this particular novel case, we actually don't think regulators are right. We think the companies are right or the industry is right. So it opens up a lot more opportunities for challenging regulators where there are novel areas. Now, my understanding is this applies a little bit more on the rulemaking side than it does on the enforcement side. And so you might see regulators in the short term pivot more of their activity to trying to enforce stuff and do more stuff through enforcement rather than through rulemaking. But in general, this was, I think, a loss for regulators. It was a boon for companies that have the opportunity or trade groups to challenge regulators more in court. And generally, it's a win for lawyers who are going to have a lot more work to do in court and a lot more opportunity to bill clients. What was your quick take on Chevron?
I mean, yeah, that is generally my limited understanding from the time I've had to read and talk to people about it. I mean, I think, given the case was argued some time ago, I'd had a couple of conversations off and on in the last few months. I mean, it is interesting from sort of like a historical perspective. My understanding is the Chevron deference is something that was argued for supporting a sort of more like right political posture in sort of like, I want to say, I don't know, the 80s, 70s, 80s,
Wasn't it
like
the
Reagan
EPA,
time?
if I'm remembering right? That was the agency at
Believe you're right. I believe you're right. Because you'll recall, like at that time, the legislative branch was more dominated by sort of left Democrats. And now, like, this is reversed where we've become a political podcast, which I try not to do. This is sort of reversed where there's a perception that the administrative state is sort of leftward leaning. And so this will sort of shift that balance away from the administrative state. So things like the EPA and in our world, the OCC and the FDIC, and shift that either, to your earlier point, back to Congress if Congress is capable of passing laws.
Which is funny. Whenever they're like, oh, Congress will just pass more laws. You're like, have you met Congress? Have you watched what's happening? Like, chances of that are basically zero.
Or in the absence of clearer legislation, shift it seems, to the courts. I am very curious to see how that goes. I mean, I know there was a recent case where I think it was Clarence Thomas accidentally wrote in his opinion referring to nitrous oxide, which is laughing gas, instead of referring to whatever he intended to, some sort of pollutant. So I'm like, putting a bunch of like really complicated banking regulatory issues to be adjudicated in front of judges that don't necessarily have a specific foundation in that is going to be interesting to
Yeah,
watch.
well, I mean, and it's a good point, right? Because I think the objection originally, the idea with Chevron deference was, I believe, regulators are the technical experts on this stuff. And so if it comes to interpreting novel products, use cases, instances, we should defer to those who have the most technical expertise. And I think the objection, if you were to listen to, let's just pick on the cryptocurrency industry for a second. If the objection that I think crypto folks have is that technical expertise is woefully lacking at regulators. Like they have not been able to keep up with technology. They don't understand why crypto is amazing, blah, 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 blah. They don't understand why this crypto thing is not a security, on and on and on. So regulators don't have the level of technical expertise to be able to adequately interpret the laws for new use cases or new products. I don't think that's an entirely unfair statement. I mean, we've seen lots of examples of regulators being a little overwhelmed and the pace of technology maybe catching them a bit by surprise. I think there is some truth to that. But as other people have pointed out on Twitter, if you thought regulators had a hard time understanding what you're doing, wait till you meet this 81-year-old judge who has no background in technology, who has no background in this industry or no understanding of the nuances of how this stuff works. Do you really want all of this to be legislated through the courts where you're not even necessarily going to get even close to the same level of technical expertise? Now, again, going to your point, Jason, if you think kind of a pro-business mindset has sort of infiltrated the court system, maybe as a business that is what you want because you just think the courts will sort of defer to businesses and not in the favor of regulators. I think that's possible, but I've been a little surprised by some of the cases that have been happening lately, like the late fee case against the CFPB for capping credit card late fees. You don't always get exactly the outcomes that you want when you put stuff in front of judges, even if they are sort of on paper on your side. So I'm not sure anyone really knows exactly what they're signing up for. I'm very confident to say Congress is not going to be passing a raft of new legislation to update these old laws. But apart from that, I don't really see this going in a great direction, but we'll have to see how that evolves. Mr. Mikula, you've been very generous with your time. I hesitate to even ask this because you've been just trapped on BaaS Island. Do you have a can't let it go for us? Do you want to is there something about BaaS you want to, just rant about for a second? Do you want some therapy? What can we do for you?
Yeah, I mean, my very brief comment will be the really unfortunate users of Synapse who are now also victims of
Oh
the
my
Evolve
God, yeah.
data breach, right? So, I mean, like, as we're recording this, they lost access to their funds on May 11th. Some of them have had those funds returned, but many of them haven't. And now they're getting, data breach. Well, they might be getting data breach notifications if, folks
Yeah.
get their act together. And it's just like a really, unfortunate situation for, people who did not ask for this and did not necessarily clearly understand the risks of the products they were using. And I will leave it
We're
there.
definitely cultivating some anti-fintech fans, which is not the outcome that any of us would want. Jason just spit out his water a little bit for those who are listening. All right, Jason, I am going to end with a can't let it go that's not related to BaaS, actually. But I don't know if you saw Klarna has made some interesting headlines for making staffing cuts and replacing staff with AI. I think predominantly in the area of customer service, where they're applying generative AI for customer service inquiries and are sort of showing the outer limits of what companies can do if they just really want to cut their, costs for paying employees and replace them with generative AI tools. The CEO of Klarna actually came out recently in an interview and said that he anticipates that they will shrink their headcount by about 20% every year because of AI. And the reason that will happen functionally is that they're going to stop recruiting. He said they've already stopped recruiting for at least a lot of roles, and that natural attrition plus that lack of recruiting will lead to a 20% decrease in headcount year over year. And I know this isn't what he's saying, but it's hard to hear that statement and not think of this is a deep cut, probably going way outside of what you're going to be familiar with. But in Star Trek Next Generation, there's an episode where Beverly Crusher, the doctor, gets transported into an alternate universe. And in this universe, it's shrinking. And so periodically people who she knows will just disappear from the universe. So she's on the Starship Enterprise and it's got a complement of 500 people. And then suddenly it's got a complement of 300 people. And she's like, that's weird. I can't find certain people I was looking for. And it keeps happening until it's just her and Captain Picard on the bridge of the ship and there's no one else on the ship. And the trick is Picard doesn't understand what's happening. And so every time the people disappear, he just thinks it's normal. And so she's trying to find out what's going on. And she's like, how does it make sense for the two of us just to be flying on this starship by ourselves? Why don't we have a crew? And he's like, we've never needed a crew before. And I can't get that picture out of my head when I think about Klarna losing 20% year over year. And eventually it's just the CEO and a bunch of generative AI agents, and they're just flying through the galaxy by themselves. So I know that's not exactly the picture that we're painting, but we might want to conceive of a different way to talk about the impact of generative AI, because I think the messaging here is a little off.
I actually was a Star Trek Next Generation person growing up. My dad and I would watch together. Like, really only that one, though. I think we did, like, Voyager as well. I am clearly
yes.
a nerd. I think I vaguely remember that episode. I mean, my one comment on that, and then we'll call it a day, is I wonder how those comments are landing internally on employee morale.
I wonder about that a lot.
Because
it's not good. Yeah, like once you leave, we have an AI to replace you. We're not going to fire you necessarily, but we do have an AI just waiting in the wings to take your job once you leave. Yeah, it's a bit strange. I think we're going to have to work on refining the messaging there. All right, Jason, been very generous with your time. You need to go and relax and decompress from all of this BaaS craziness. We'll do this again next month, but until then, thank you, sir. It was great to see you.
Thank you.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.